Alright, let's talk about something that sounds incredibly boring. I'm talking about monetary policy. Yes, those two words right there. They probably make your eyes glaze over. You're thinking, John, why? Why are you doing this to us on a perfectly good Tuesday in 2025? And look, I get it. It sounds like something only people in ill-fitting suits who use too many acronyms should care about. But here's the kicker. Monetary policy affects you. Yes, you. The person currently wondering if ramen counts as a balanced meal for the 7th night in a row. It affects your job prospects, the price of that avocado toast you can't afford, and even how much that soul-crushing student loan is going to cost you, so buckle up. In simple terms, it's what a country's central bank does to control the amount of money floating around in the economy. Think of it like a giant tap. The central bank can turn the money tap on, letting more cash flow into the system. Or they can turn it off, or even try to suck some money back out. They do it to try and keep the economy running smoothly. They want to avoid prices going completely haywire, which is called inflation. And they want to make sure people can find jobs, which is, generally a good thing for society. It's a delicate balancing act. The idea is that by managing the money supply, the central bank can influence things like interest rates. The ultimate goal here is economic stability, and the folks in charge of this? So, who are these shadowy figures pulling the monetary levers behind the curtain? In the good old US of A, the main player in the monetary policy game is the Federal Reserve. Often called the Fed, it sounds like a government agency, doesn't it? Like the FDA, but for money. And while it was created by an act of Congress and its leaders are appointed by the President and confirmed by the Senate, it's designed to be independent. Yes, independent. That means, in theory, they're supposed to make decisions based on what's best for the economy, not what's politically popular or what will get some politician re-elected. This independence is a pretty big deal. Imagine if politicians whose main skill is often promising everyone everything all the time were directly in charge of printing money. The temptation to just crank up the money printers before an election to make everyone feel rich would be immense. The Fed's independence is supposed to prevent that kind of short-sighted nonsense. So, the Fed exists. It's independent, mostly. It has a committee that makes big decisions. But what are they actually trying to achieve with all this monetary policy wizardry? What's on their official government-mandated to-do list? Well, Congress, in its infinite wisdom, has given the Federal Reserve what's known as a dual mandate. That sounds fancy, doesn't it? Dual mandate. It means they have two main jobs. First, to promote maximum employment, and second, to maintain stable prices. And yes, sometimes these two goals can feel like they're pulling in opposite directions. It's a constant balancing act. Let's break down maximum employment. This doesn't mean zero unemployment because in a dynamic economy, some people will always be between jobs or just entering the workforce. Instead, it means striving for the highest level of employment the economy can sustain without triggering runaway inflation. Alright, now we get to the fun part, the actual tools the Fed uses to poke and prod the economy. It's not like they have a giant lever labeled more jobs or less inflation. If only it were that simple. Instead, they have a few key instruments in their orchestra of economic management. The most important and frequently used of these is something called open market operations, or OMOs, if you want to sound like you're in a secret financial society. It sounds complicated, but the basic idea is surprisingly straightforward. The Fed buys and sells US government securities, mostly treasury bonds, in the open market. Hence the name, see? Not so scary. When the Fed wants to increase the money supply and encourage lending and investment, perhaps because the economy is a bit sluggish, it buys these government securities from banks. Think of it like this. The Fed walks into the financial marketplace with a big bag of cash and says, "Hey banks, anyone want to sell me some of those government bonds you're holding?" Section 5, OMOs in the wild making interest rates dance, like no one's watching, except everyone is. So we've established that open market operations involve the Fed buying and selling government bonds. But what's the immediate practical effect of all this high finance horse trading? Well, the main target of OMOs is a very specific, very important interest rate called the federal funds rate. This isn't a rate you or I directly pay. Instead, it's the interest rate that banks charge each other for overnight loans of reserves. Yes, banks lend money to each other, constantly. They need to do this to make sure they have enough reserves on hand at the end of each day to meet their requirements, more on those later, or to cover customer withdrawals. It's like borrowing a cup of sugar from your neighbor if your neighbor was another multi-billion-dollar financial institution. When the Fed buys bonds through OMOs, it injects reserves into the banking system. Suddenly banks have more cash on hand. Section 6. Tool number 2, the discount rate, the Fed's slightly less shady lending window. Alright, open market operations are the Fed's main squeeze, their go-to tool for everyday monetary policy, but they have a couple of other tricks up their sleeve. One of them is the discount rate. Now this sounds a bit like something you'd get at a January sale, doesn't it? All interest rates 20% off. Unfortunately, it's not quite that exciting. The discount rate is the interest rate at which commercial banks can borrow money directly from the Federal Reserve itself. Think of the Fed as a lender of last resort for banks. If a bank is a bit short on cash and can't easily borrow from other banks in the federal funds market, it can go knock on the Fed's door and ask for a loan. This is done through what's called the discount window. Now, banks generally prefer not to borrow from the discount window if they can help it. There used to be a bit of a stigma attached to it, like, ooh, look at First National Bank, they had to go to the Fed for cash, they must be in trouble. While that stigma has lessened somewhat, especially during financial crises when everyone is scrambling for liquidity, banks still usually try to get their overnight funding from other banks first. Section 7, tool number 3, reserve requirements. How much dough banks keep stashed? No, really. Our third and final major tool in the Fed's monetary policy toolkit is something called reserve requirements. This one is pretty much what it sounds like. The Fed can legally require banks and other depository institutions like credit unions to hold a certain percentage of their customers' deposits in reserve. This means they can't lend out every single dollar that people deposit. They have to keep a fraction of it either in their vault cash or on deposit at their regional Federal Reserve Bank. It's like your mom telling you that you can't spend all your allowance on candy, you have to save some of it. Except in this case, mom is the central bank and candy is, well, loans that make the economy go round. The idea behind reserve requirements is twofold. Section 8. The Grand Economic Ballet, using the tools in harmony, or desperation. So, we have these three main tools: open market operations, the discount rate, and reserve requirements, even if that last one is mostly gathering dust. How does the Fed actually use them in the real world with its messy, unpredictable economy? Well, it's not usually a case of just picking one tool off the shelf. Often the Fed uses them in concert, or at least ensures their settings are consistent, to send a clear message about its policy intentions. Think of it as an orchestra conductor trying to get all the different sections, the strings, the brass, the woodwinds, to play together to create a beautiful symphony. Or, if they get it wrong, a horrendous cacophony that makes everyone's ears bleed. No pressure, Fed. Section 9. So, should you, a future taxpayer, actually care? Spoiler, yes, you absolutely should. So, after all that talk of open market operations, discount rates, and the Federal Reserve's dual mandate, you might be sitting there, possibly next to a dangerously leaning tower of textbooks thinking, okay, John, that was a lot. But does any of this matter to me, a humble student just trying to pass organic chemistry and figure out what to do with my life? And the answer, my friends, is a resounding, unequivocal, and slightly terrifying, yes, it absolutely matters. Monetary policy isn't just some abstract concept for economists to argue about in academic journals that no one reads. It has real, tangible effects on your daily life, your future prospects, and the world you're going to inherit. Think about it. When the Fed lowers interest rates to boost the economy, it can make it cheaper to get a student loan, though let's be honest, those are still a nightmare. It can make mortgages more affordable, which might one day, Yao Wu Chi, allow you to dream of owning something larger than a shared dorm room. More importantly, an economy stimulated by lower rates often means more job creation. So, when you finally graduate, armed with your degree and a mountain of debt, the Fed's actions can influence whether there are actually jobs available for you.